Have you ever wondered what money really is or what banks actually do? Well, look no further. This Root-Debugged Banking 101 session will surely give you a lot of new perspectives. The British Positive Money activist group has made a collection of very educative and worthwhile animations about our current monetary system based on the book Where Does Money Come From? With small corrections, which we'll be making on this comment track, they could be considered almost compulsory viewing at schools. Public policy discussion would be on a much more constructive basis if we corrected the prevailing misunderstandings and myths about how money works. Though the description is mostly accurate, unfortunately the conclusions the Positive Money team draws and the reform suggestions they make seem to be driven by a negative emotional association with debt and to be strongly influenced by the quantity theory of money, which assumes that the amount of money in existence drives up the prices of both consumer goods and investment assets and directly affects aggregate demand.
And that's the situation we're in now. We have 2.5 million people sat at home doing absolutely nothing because the economy has ground to a halt. And that's because there isn't enough money circulating. So we do need to put some money in to get this system going again.
But the money multiplier models are not the only outdated and illogical frameworks they still teach in schools as undisputable fact. What we have to understand is that many mainstream economic theories are also based on this misleading description of the banking system. The Positive Money team's suggested solution of full government-created money.
Instead of letting banks create our money, the state could create it, free of debt. And instead of lending money into the economy through mortgages and loans, it could be spent into the economy.
Would practically make money the wholly speculative, intrinsically worthless fiat paper money, which many critics, including gold standard advocates, assume dollars and pounds in our current system are.
There have been thousands upon thousands of fiat currencies that are unbacked by gold or silver, and they have all gone to zero because governments can print more and more and more of it.
They tell you that there's no intrinsic value in their money. They'll tell you that they print it backed by absolutely nothing.
The current monetary system is a big fraud. It's a big Ponzi scheme, which is a very bad and evil system.
While governments make new money by printing more at the mint,
The dollar is a real money.
And unfortunately, the national currency is just a fiat piece of paper at this point.
The best thing about our current monetary system is precisely that euros, dollars and pounds are not commodities of a limited supply printed by the central bank, which we would be using as mediums of exchange. It is a credit money system, essentially a system for keeping account of how much people and institutions owe each other. And owing is not about owing cash, but real goods and services. It is not a storage and redistribution system for excess notes and coins, but like a big time bank network, except that the value of savings and debts is not fixed to hours of work, but to these units of account called dollars, pounds, and euros, etc.
It's all just promises.
As these videos clearly demonstrate, money is simply liquid credit, receivables from others that we can easily transfer between accounts to pay each other for goods and services, and the quantity theory in this system would essentially mean that people owing each other more or an increase in the liquidity of their savings would always make them more eager to spend, which does not sound like a very realistic assumption.
If they keep expanding the money supply so vastly, why aren't our prices growing faster than they really are?
When banks create money by making loans, which by the way are both misleading expressions, they also create more demand for the money in the form of the loan, as the debtor needs to save to shorten his debt. Understanding a bit of corporate finance, the profit requirements of capital, and the monopoly nature of land helps one see why the availability of credit is not a sufficient explanation for real estate bubbles or other rises in asset prices either.
Most of this money goes into house price bubbles and gambling on financial markets. This has led to ever-widening inequality, the highest personal debt in history, and house prices that very few people can afford.
all land is unique in location and providing access to resources, and this becomes increasingly important as communities develop.
As populations increase and communities develop, land prices rise, as if by magic. Location, location, location. Land speculators know that demand for special places delivers easy profits.
Landowners within 300 metres of each new station gained an average windfall of £200,000 per home.
Central banks in the last decades have been successful at keeping the consumer price level in our currencies predictable because, until getting stuck at the zero lower bound, they have in practice controlled not the quantity of money, but the cost of holding debt and the profitability of monetary saving by affecting interest rates. In this way, it has kept the supply and demand of capital, and hence the supply and demand of labor in balance, affecting average pressures to raise or lower wages. The mechanism is explained in more detail in the book Fixing the Root Bug. This commented version of the Positive Money Team's videos makes a couple of small corrections and presents an alternative solution which makes it profitable for banks to stay solvent and transparent while allowing them to remain creative in their main line of business, risk management, and also allows balancing aggregate supply and demand in the economy without the need for fiscal stimuli or trying to indebt other national economies further and further, which is what Western economies are currently doing. In short, we suggest that the main problem in our current monetary system is not the non-limitedness of the money supply, but 1. The zero lower bound of interest rates, and 2. The fact that the government guarantees bank deposits practically for free, allowing much more room to drop real interest rates negative, either by eliminating cash altogether or adopting a higher inflation target, and charging a proper price for the government deposit guarantee would be the most effective and fair way to cut down the amount of debt and excessive monetary savings in our economy, deleveraging it. This claim, of course, is in strong contrast with prevailing new Keynesian and monetarist theories, which assume the outdated money multiplier models, the quantity theory, and that lower interest rates would always make people borrow more, omitting the effect that deposit rates can have on people's willingness to hold risk-free credit, which is wholly unproductive, unemployed capital. We'll start from part 3 out of 6, as this is where we get to how the current system actually works. There isn't much to correct for the first 5 minutes, except that the whole expression of creating money, which Ben likes to use a lot, is slightly misleading as money in our current system is a debt relationship, more like a position than a possession. And you wouldn't say that you create meters or create distance when you move away from someone. Granting credit would be more descriptive. Similarly, the expressions of lending money, borrowing money, and deposits are emblems of this whole misleading mental image, the conceptual metaphor that we have in our heads of money as some kind of substance that is in existence.
One factor is that there's a great fault in the language that we use, or a great bias in the language that we use in relation to banking. The word deposit is a hangover from the days of the goldsmiths who took bags of gold for safekeeping. And we also speak of banks lending money. Banks do not lend money.
The Positive Money Team interestingly concludes that we should adjust the real world to match what our language assumes of it.
Actually, all we're doing is making the system work the way that most people think it already works.
As Rory Sutherland says,
now, if your perception's much worse than your reality, what on earth are you doing trying to change the reality?
And now, finally, let's see the animations.
Before we start looking at how money is really created, we need to have a quick look at what types of money we actually use in the economy. There's actually 3 types of money that we use in the economy. As a member of the public, you will only ever have used 2 of them. The simplest form is cash, the £5, £10, £20 and £50 banknotes, and the metal coins that most of us will have in our wallets at any point in time. As you probably know, only the government, via the Royal Mint and the Bank of England, is allowed to create these. If If you try to make your own at home, pretty soon you'll get the police kicking down your door at 2 in the morning. So, now imagine that you need to pay your rent and your landlord has an account with a different bank to you. When you log into your internet banking and make the payment to your landlord, your bank has to send some money to your landlord's bank to settle and complete the transaction. Of course, the banks don't want to make these payments to each other in physical cash because carrying all this money around is dangerous, even if they use protected security vans and guards with bulletproof vests and helmets. So, instead, they use a type of electronic money, which is called central bank reserves. Remember that name, because we'll be using it a lot in this video. Central bank reserves are effectively an electronic version of cash, and banks use these electronic central bank reserves to make payments to each other. The central bank reserves are created by the Bank of England. We'll cover how later on. And they can only be stored in accounts that the big banks have with the Bank of England. To get one of these bank accounts at the Bank of England, you have to be a bank. So as members of the public, we can't get our hands on any central bank reserves. We just have to use the physical cash. So the first 2 types of money are 1, cash, and 2, central bank reserves. Remember that central bank reserves are like an electronic version of cash that only the banks can use to make payments between themselves. The third type of money is a type of money that isn't created by the Bank of England, the Royal Mint, or any other part of government. This third type of money is the type of money that's in your bank account right now. This money is just numbers in a computer system. Bankers and economists refer to this type of money with jargon such as bank deposits, demand deposits, sight deposits, or bank credit. These terms all pretty much mean the same thing and are used interchangeably. They might also be referred to as bank liabilities. This is the accounting term, because this money is a liability of the bank to you, i.e., it's what the bank needs to repay you at some point in the future. Now, in a legal sense, the numbers in your account aren't really money at all. But despite that, they serve exactly the same purpose as the £10 and £20 notes that you might hold in your wallet. It's this type of electronic bank deposit money that now makes up over 97% of all the money used in the UK economy. Less than 3% of the money supply is cash created by the government. And all this electronic bank money is created by banks, as we'll explain now. The balloon model. Let's revisit the multiplier model that we saw in the last video. Remember that it describes the money system as having a base of base money. In the simplified version, the base is made up of cash. In reality, it's not just cash in this base, it's also the electronic central bank reserves that banks keep in their accounts at the Bank of England. But it's true that this base is made up of money, either cash or electronic, that was created by either the Bank of England or the Royal Mint. Now let's look at the top of the pyramid. The rest of the pyramid is made up of the third type of money, the electronic bank-created money. So the pyramid is split up into a base of government-created money and a tower of bank-created money on top. Remember that we said this pyramid in theory is limited by the reserve ratio? Well, there is no reserve ratio, and there hasn't been for years. This means that the total amount of money in the economy isn't really limited. It can keep expanding without coming to a point at the top. So the pyramid is actually the wrong shape to describe the money system. In reality, it's closer to a balloon of bank-created money, wrapped around a smaller balloon of base money. In this case, the base money is the electronic central bank reserves and cash. As we'll see in this video, the Bank of England has relatively little control over the total size of the balloon of bank-created money. They can't really control how much money is in the economy, even if they claim to be able to. The outer balloon of bank-created money could expand out of control, and the Bank of England wouldn't be able to stop it, at least not within the current monetary system. We saw this happen before the crisis. In 2006, the outer balloon of bank-created money was 80 times bigger than the inner balloon of base money. The multiplier wasn't 10 times like the textbook models suggest, it was actually 80 times. And then when banks panicked during the crisis and refused to lend, the Bank of England pumped a load of extra base money into the inner balloon through the scheme known as quantitative easing. But this didn't lead to a massive increase in the size of the outer balloon. Right now, the outer balloon, the amount of bank-created money, is only 14 times bigger than the inner balloon. This shows that there is no real connection between the amount of central bank reserves or base money and how much money that the banks are able to create. So what actually affects the ratio between bank-created money in the outer balloon and government-created cash and central bank reserves in the inner balloon? What determines how much money is created for the economy? The research that we've done suggests that the amount of money that banks can create is not determined by reserve ratios or by regulation or by the control of the Bank of England. The reality is that the total amount of money depends on the confidence of banks. If they're feeling confident, banks will create new money by lending more. And when they're scared, they limit their lending, which limits the creation of money. So the size of the outer balloon really depends on the confidence and incentives of the banks. Or to put it another way, the amount of money in the economy depends on the mood swings of bankers.
This is the first false conclusion. Let's remember that individual banks aim to maximize their profits and will hence make any loan that they deem profitable, or rather grant any credit that they deem profitable, as they're not actually lending anything that they'd already have. The profitability of a loan, if we'll allow that word, is determined by the debtor's risk profile and the interest rate margin the bank charges for the loan. So essentially, banks just set the prices, the interest rate margins at which they're willing to grant credit to individual wannabe debtors according to assessed risks. The main purpose of the whole private banking sector is to find fair market prices for risks in the economy. Finally, it is the desire of people, companies, and other institutions to take on more debt at the available interest rates that determines the amount of money. This is also what Charles Goodhart says in the foreword to Where Does Money Come From? Of course, the inability of some debtors to earn income and pay their debts back in time can additionally prevent the amount of money from shrinking. Each bank has its own processes and policies for assessing risks and offering rates. It is seldom a matter of the momentary mood of a single banker. And if one bank refuses to grant a loan for some subjective reason, it misses out on a good profit-making opportunity which a competing bank might grasp. A wannabe debtor can also find another willing person to back up his debt. If no bank and no one else is willing to carry the default risk of a debt, that debt clearly should not be granted, should it?
Given that the amount of money in the economy can determine the health of the economy, does it sound like a good idea to have such an important thing decided by the mood swings of bankers? Probably not.
Additionally, as mentioned in the intro, this assumption that the quantity of money, the amount of liquidity, would be a decisive driver of the economy should seriously be questioned in a system where money is essentially just how much people owe each other and how much of that credit they happen to want to keep on liquid accounts.
Okay, back to the numbers in your bank account. These numbers are all created by banks. The vast majority of these numbers were created when somebody took out a loan from a bank. Let's see how this happens. A customer, who we'll call Robert, walks into a Barclays bank and asks to borrow £10,000 for home improvements. Barclays runs a quick automated credit check and decides that the customer can be relied on to keep up repayments on the loan. The customer signs a loan contract promising to repay the £10,000 plus the interest over the next 4 years, according to an agreed monthly schedule. This loan contract is a legal contract that binds the customer to make repayments to the bank. This means that it is a legal contract that is considered to be worth £10,000 plus the interest. Because it's an asset, Barclays can record the loan on its balance sheet. Now, if you haven't come across a balance sheet before, don't worry, it's pretty simple. There's two parts to a balance sheet. One half records all the things that the bank owns. This could be money, other financial products like bonds and derivatives, bank buildings, computers, and most importantly, the loans it's made. How can you own a loan? Well, if someone signs a contract promising to pay you money, then that contract is worth something. It's considered an asset of the bank. In the case of Robert, the contract that he signs promising to pay the bank £10,000 plus interest over the next few years is worth at least £10,000 to the bank, and therefore it is an asset to the bank. So the bank puts an extra £10,000 on its balance sheet like this. Now, what about the other half of the balance sheet? The other half of the balance is what's called the liabilities. This is a record of everything the bank owes to other people. On this side, you'll find a record of money that the bank has borrowed from other banks or large pension funds. You'll also find all the customers' accounts, because if you remember, the balance of your account is just a number showing what the bank promises to pay you when you ask for your money back. When Robert signed the contract promising to pay the bank £10,000 plus interest over the next few years, he did it because he wanted some money from the bank. So the bank creates a new account for Robert, which is linked to his debit card, and just types £10,000 into their computer records. This £10,000 is a liability from the bank to Robert, and it shows up on the other half of the balance sheet. Now, when Robert goes to the cash machine to check his balance, he'll see £10,000, which he didn't have before. All the bank has done to create this new money is type some numbers into an account. It hasn't reduced the balance of anyone else's account, and it hasn't taken any money from some pensioners and moved it into Robert's account.
Precisely. And this is why the whole expression of banks lending on their depositors' money is misleading and leads to completely false economic conclusions.
Banks do not lend money.
While intuitively we think that people and businesses make money, as the American expression goes, when they work or make a profit, and that banks would be passing that money on to others when they grant loans, the reality is the exact opposite. Banks create money when they make loans, and that money is passed on when people buy products and services, or when companies pay wages to their employees. Although for an individual it might look like it, on the level of the whole economy, money is not work somehow magically stored into notes and coins or in bank accounts, but simply receivables from others, credit on them. This is good to remember the next time when someone argues, for example, that saving is never bad and can't hamper the economy because banks would be keeping the money in circulation and in productive use. Banks do no such thing. This is pretty much a children's bedtime story set in a fictional world where all money is physical cash, all transactions are done by handing over such cash, and the cash is only deposited in banks for longer-term saving. But unfortunately, it's a story in which most adults and many economists still believe. Additional monetary saving does not increase banks' ability to grant loans or lower interest rates for borrowers.
As I said, when I was a student in the late 50s and the early 60s, it was widely understood, absolutely taken for granted, that the causality went from loans to deposits. Loans create deposits. Now, students are all taught that banks lend on deposits, that deposits create the ability to lend and banks respond to that. This is a regression.
Arguing that in an economic recession, we'd have to raise interest rates to encourage monetary saving to spur more real investment makes about as much sense as arguing, for example, that we should tighten the protection of storks to increase human birth rates, on the grounds that this would make it easier for storks to bring babies to married couples, or lobbying for wider chimneys to improve Santa Claus's working conditions.
Not only does inflation slowly eat away at individual wealth, but it also disincentivizes savings. And without savings, there's nothing to invest.
Read the reports of the World Bank, and they all talk about insufficient saving for development. It's absolute nonsense.
These arguments seem sensible as long as you believe in the respective children's story literally, ignoring any empirical evidence and mathematical facts. When electronic money is the most liquid form of money as it is today, and most money is on bank accounts, saving money just slows down the circulation velocity of money, and excessive monetary saving is effectively keeping others in debt. If the final net creditors, the savers, hang on to their money, the credit, there is no way debtors can get rid of their debt, except by someone else, like the government, taking on more debt.
So the process of creating commercial bank money, that's the money that the general public use, is as simple as 1. A customer signing a loan contract, and 2. The bank typing numbers into a new account set up for that customer. This new bank-created money represents new spending power or money in the economy. Robert can now go and spend his money anywhere in the economy using his debit card, checkbook, internet banking, transfers, or even by taking cash out of an ATM.
In other words, the bank creates liquidity by granting Robert credit, which it backs up and which is finally guaranteed by the government, making it risk-free to hold. By buying things from others with this liquid credit, Robert can fall into debt to these people via the bank without those people carrying his default risks. The bank, acting as an intermediary, has agreed to carry those risks in exchange for the interest margins it charges.
But there's a small complication. What happens if Robert goes and spends the new bank-created money with a shop that has a bank account with a different bank, say Lloyd's? If this happens, then Lloyd's will want to see £10,000 of real money from Barclays. Barclays would then need to transfer £10,000 of central bank reserves to Lloyd's to settle the transaction. Note that from the point of view of Lloyd's, receiving a transfer of £10,000 in central bank reserves into its account at the Bank of England is just as good as Barclays pulling up in a truck and dropping off £10,000 in cash, although it's much more convenient for the banks to have the electronic central bank reserves than to carry around all that cash. This process of banks making payments between themselves is called interbank settlement, and it's really important to understand it because it's crucial to the way that banks have been able to gain control over the entire money supply.
Or rather, how the amount of money is determined by the needs and desires of the market. In other words, how money is endogenous, and how its quantity is not in any way an important factor in how the central bank interest rates affect inflationary and deflationary pressures.
First, let's look at the simplest example of interbank settlement, with just two banks and two customers. Robert, when he receives his loan, goes straight into a DIY store and spends £10,000 on everything he needs. He gets to the checkout and pays using his Visa debit card. Here's a simplified version of what happens behind the scenes. First, the DIY store's debit card machine automatically contacts Visa and says, "Please charge £10,000 to this card number, da-da-da-da-da." Visa's computer systems then dial up Barclays' computer systems and say, "Robert's trying to spend £10,000 on his debit card, is that okay?" Barclays' computer system check the balance of the account and says yes. Barclays' computer system then reduces the balance of Robert's account by £10,000. Now, Visa's computer system contacts Lloyd's and says, "I'm sending you £10,000 for the DIY store's account." Lloyd's then updates the balance of the DIY store by £10,000. However, importantly, when the owners of the DIY store log into their internet banking, they see two figures. One says account balance and the other says available now. For the next couple of days after Robert's come into the shop, the account balance will be £10,000 higher than the available now balance. The £10,000 that Robert has spent isn't available to the DIY store for them to spend just yet. Why? Well, behind the scenes, Barclays needs to settle with Lloyd's. When Lloyd's gets the message that someone has spent £10,000 in the DIY store, it updates their account balance and then calls Barclays to say, "Send me the money." Barclays could settle with Lloyd's by delivering the £10,000 in cash, but in reality this is just a hassle for both banks. They'd have to find somewhere to store all the cash and a van with security to transport it. So instead, Barclays will settle by making a £10,000 transfer from its reserve account at the Bank of England to Lloyd's reserve account at the Bank of England. Once Lloyd's gets the £10,000 in its account at the Bank of England, then it will update the available balance in the DIY store's account. Now, this was a simple example that involved just one payment between two bank customers, Robert and the DIY store. Only two banks are involved. But in the UK right now, there's around 50 million people with bank accounts. Some of these people make more than one electronic payment a day, and they bank with over 50 different banks. In fact, every day, over 60 million transactions are made between bank accounts in the UK through a number of different payment systems, including Visa, MasterCard, direct debit, and online bank transfers. If banks had to go through the whole hassle, in the example with Robert, every time someone bought a sandwich from a supermarket using their debit card, it would get very messy very quickly. But there's a clever way of simplifying the whole thing massively. It's called multilateral net settlement. When you have a lot of individuals and businesses all making payments to each other, that's a lot of money flowing between the different banks. So what the banks do, especially with systems like BACS, which manages direct debits and the type of bank transfers that you make via internet banking, is this. First, they put all the payments into a big computer database without actually moving any real money, cash or central bank reserve, about.
Instead of real money, we should say base money or just central bank money. As they explain in part 5, bank deposits are just as much real money as cash is.
Then, at the end of the day, or every few hours, they run a process to cancel out as many of the payment flows as possible. For example, imagine a customer at Lloyd's sends his rent, £350, to his landlord's account at Barclays. But on the same day, a customer at Barclays sends his own rent, £400, to his landlord, who happens to be at Lloyd's. The two payments almost cancel each other out, so after cancelling out, or netting in the official jargon, the only money that really needs to be moved is £50 from Barclays to Lloyd's. Because there are millions of payments being cancelled out by this system, the amounts that actually need to be transferred between the banks at the end of the day are usually just a tiny fraction of the total value of the payments made. And this is why, even though in 2007 RBS customers had nearly £700 billion in its customers' accounts, RBS itself only had £17 billion that it could actually use to make payments on behalf of those customers. This £17 billion was more than enough for the total netted payments that it would need to make at the end of the day. This netting out effect means that a bank only needs to have a very small amount of available money compared to the total amount that they owe to customers at any particular time. They know that any payments they make to other banks are likely to be cancelled out by payments coming back to it. On some days, the bank customers will spend more than they receive, and at the end of the day, the bank must pay some of its money across to other banks to settle these payments. But on other days, customers will receive more in salaries and other income than they pay out, and the bank will end up receiving money from other banks at the end of the day. Over time, the total amount of money needed by the bank doesn't change much. The only time that they would actually need all the money that they owe to their customers is if customers were to panic and ask for their money back at the same time. This is what happened to Northern Rock in the UK and Wachovia in the US, and it can destroy a bank very quickly.
This is what is called a bank run. But in the current system, as the government guarantees deposit accounts, they are just as risk-free assets as cash, and therefore there should be no reason why clients should get out cash due to solvency concerns. If everyone wanted their money out as cash, the central bank acts as the lender of last resort, which means that it would lend all that cash to the bank. Of course, in the case of a big bank, printing all that cash to replace central bank account entries could take some time, but eventually this would only make the same credit relationship between bank debtors and the savers to run through the central bank. The bank run of Northern Rock was in this sense unnecessary collective paranoia.
This process is what gave rise to the term fractional reserve banking, because banks only need to keep enough money to repay a fraction of their customers at any time.
The term fractional reserve banking is largely used in the context of the money multiplier perception of banking, and it is quite a misleading and outdated term. The fractions and reserve requirements don't apply much in practice, as they will explain in Part 4.
We talked about the central bank reserves that banks keep in their accounts at the Bank of England. These reserve accounts don't store cash, just electronic central bank reserves. It's important to appreciate that although central bank reserves are created by the Bank of England, they're still just numbers in a computer system. These numbers are just stored on a file very similar to an Excel spreadsheet, and we could create 1 billion of them in the time it takes to type out the number you see on your screen. The £150 billion of central bank reserves are no more tangible than the numbers on this screen, and in fact, the entire record of balances of the central bank reserve scheme will take up less space on the Bank of England's computer hard drive than the average song on an MP3 player. Now, the computer system that records all these central bank reserves is referred to by the Bank of England as the real-time gross settlement processor, or RTGS processor. Now, real-time gross settlement isn't as complicated as it sounds. Settlement simply means that it's a system that banks can use to settle their payments to each other. In other words, it's a way for them to transfer money to each other. Real-time gross settlement means that any payment instruction sent to the computer system is processed immediately. If a payment of £100,000 is sent to the system, £100,000 will be transferred automatically. This is in contrast to multilateral net settlement that we discussed just before, in which all the payments are queued up, cancelled out against each other, and only the final net difference is transferred. When a payment is put through the RTGS processor, it's considered to be final. It's also considered to be risk-free. If one bank owes money to another bank, there's always a small chance that it won't be able to pay the other bank. But once the money's arrived in the central bank reserve account, then the deal is finished, because holding central bank reserves is just like holding cash. It's the safest asset you can have. So, at the end of the day, the multilateral net settlement payment systems will cancel out all the smaller payments between different banks, and then they'll tell the real-time gross settlement processor how much the net differences owed between the banks should be. The RTGS system will then transfer the central bank reserves from the banks that owe money to the banks that are owed money. So, let's recap everything we've covered so far before we look into what actually determines how much money the banks can create. We've seen that the textbook model of money creation suggests that there's a base of central bank or government-created money on top of which the commercial banks can blow up the total money supply by relending the same money over and over again. We saw that this model is actually completely inaccurate. There's no natural limit to how big the money supply can grow, so it's actually better to think about this as two balloons rather than a pyramid. We saw that banks can create money by simply typing numbers into a customer's account when they make a loan. When you sign the contract, the bank gets an asset that balances out the new liability they create when they type numbers into your account. When a customer spends the money the bank has just created, and those payments go to the customers of other banks, then the other banks will call the bank that created the money and ask for them to settle in central bank reserves. But before this happens, payment systems like BACS and Visa Debit will cancel out the payments against each other, so that only the net difference at the end of the day has to be settled, i.e. transferred between the banks. This netting out significantly reduces how much money banks really need to keep at any particular time. In a few minutes, we'll see what actually limits how much money the banks can create. But first, it's worth asking whether the numbers that banks create can really be considered money. So what actually limits how much money the banks can create? You've probably seen the standard multiplier explanation of fractional reserve banking that we discussed in an earlier video. In this model, the banks have to keep a percentage of their customers' money in reserve. The reserve ratio given is usually 10%, which means that for every £100 paid into a bank by customers, the bank must keep £10 in reserve somewhere. This means that the banks can only expand the money supply up to 10 times the amount of real government-created money. We said that this model of banking is completely inaccurate, at least in the UK. For a start, the required reserve ratio in the UK isn't 10%, it's 0. But more fundamentally, the reserve ratio would only actually limit the amount of money that banks can create if the reserve money were actually taken out of circulation and put into a safe deposit box, or an electronic equivalent. If the Bank of England actually required banks to hold £10 of cash or central bank reserves for every £100 that they typed into their customers' bank accounts, then that would limit the money supply to around 10 times the amount of base money, the cash and central bank reserves. The pyramid model would then actually apply. But this is almost never what happens. When there was a reserve ratio in the UK, it was what was called a liquidity ratio. A liquidity ratio is deceptively similar to a reserve ratio, but fundamentally different. A liquidity ratio requires banks to hold liquid assets equal to a percentage of their deposits. So if a liquidity ratio was set at 10%, then a bank with £100 in a customer's account would need to hold £10 of liquid assets. Now you're probably thinking, what's the difference between this and the normal reserve ratio? Well, the key point is the term, liquid assets. Liquid assets include cash and central bank reserves, but they also include other things, in particular government bonds. While the reserve ratio used in the textbook model of banking requires banks to hold cash and central bank reserves in proportion to the total balances of their customers' bank accounts, a liquidity ratio actually allows the banks to use that cash and central bank reserves to buy bonds. The bonds also count towards the liquidity ratio, meaning that the bank could not hold any cash or central bank reserves and still meet the ratio. But the key detail here is that when a bank uses central bank reserves to buy bonds, the central bank reserves then belong to another bank. In other words, they're not removed from circulation, they're still circulating through the system.
A small addition here. Government bonds are only bought with central bank money when bought from another commercial bank. In all other cases, they are bought with commercial bank money, deposit entries. This applies both to bonds that are already on the market and new ones issued by the government. To pay the wages of its employees and its suppliers' bills, the government needs account balances of commercial bank money. So when a bank buys a bond, it simply credits the account of the previous bondholder. In the case of a newly issued bond, the account of some government agency at a commercial bank. The bank's central bank account is not touched, and the bank's balance sheet grows by the bond and the new deposits. This, of course, does not refute that in the UK system, bonds would be accepted towards meeting a bank's liquidity requirements. This is quite understandable, as essentially the bonds of governments with their sovereign currency only differ from their central bank money in that they are less liquid for non-bank investors and that their interest rates are often fixed for a longer period of time. Essentially, they are almost as risk-free assets in terms of default risks. The liquidation value of non-indexed bonds can of course drop when nominal market interest rates are expected to rise, as the yield of the bonds adjusts to interest rates by their value changing.
This means that a liquidity ratio, as opposed to a proper cash and central bank reserves ratio, has no limiting effect on the total amount of money that the banking sector as a whole can create. So a liquidity reserve ratio will not limit the banking sector's total ability to create money. We did used to have a liquidity reserve ratio in the UK. In fact, from the mid-19th century, banks tended to keep an average of 60% of liquid assets as a proportion of their total liabilities. This was actually a self-imposed reserve requirement. It's what the banks knew they needed to keep back in order to avoid the risk of a run on the bank. In 1866, there was a banking crisis, and the Bank of England then took on the role of lender of last resort, committing to lend to banks if they ran out of money to make their payments. Once this safety net was in place, banks reduced their liquid reserves to around 30%. In 1947, when the Bank of England was nationalised, they imposed a formal liquidity reserve ratio of 32%. This reserve ratio required banks to hold £32 of cash, central bank reserves and government bonds for every £100 balance in customers' accounts. Of course, because government bonds would earn the banks some interest, unlike reserves and cash, the banks would try to hold as much of this 32% as possible in the form of bonds. In 1963, this liquidity ratio was dropped to 28%. Then, in the words of the Bank of England,
before 1971, the clearing banks had been required to hold liquid assets equivalent to 28% of deposits. From 1971, this was relaxed and extended, requiring all banks to hold reserve assets equivalent to 12.5% of eligible liabilities. This combination of regulatory and economic factors coincided with one of the most rapid periods of credit growth in the 20th century. It also contributed to an ongoing decline in banks' liquidity holdings, ultimately to below 5% of total assets by the end of 1970.
In this phrase, credit growth really means a massive expansion in the amount of bank-created money, and consequently a massive rise in debt.
This is why it is quite hypocrite to blame rising amounts of debt purely on the debtors, especially when there is unemployment and when much of the debt is taken on by the government to keep the system running and to prevent deflationary pressures and further unemployment. Involuntary debt is the result of creditors hoarding up more of their credit and not spending it to give the debtors the chance to earn it and pay off their debts with it.
Finally, in 1981, the liquidity reserve ratios were abolished altogether. So if the Bank of England no longer sets a liquidity reserve ratio, is there a natural requirement for banks to keep liquid reserves in proportion to their total customer accounts? In other words, is the system naturally limited? Well, let's look at the central bank clearing system again. Remember that there are 46 banks with reserve accounts at the Bank of England. At the end of the day, when all the payments are cancelled out against each other, these banks have to settle between themselves by transferring money between these reserve accounts. Now, the important thing is that this system of central bank reserve accounts is a closed loop. It's technically impossible for any central bank reserves to leave the loop, because central bank reserves are by definition numbers in accounts at the central bank, and only the Bank of England is able to actually create or destroy central bank reserves. So when all the payments are cleared at the end of the day and the banks find out how much they actually need to transfer to settle up, some banks will end up having to pay money to other banks and other banks will end up receiving money from other banks. What happens if one bank doesn't have enough central bank reserves at the end of the day to make its payments to other banks? Well, because it's a closed-loop system, it's mathematically certain that one of the other banks will have more money than it needs to make its payments. What happens then is that the bank that has more central bank reserves than it needs lends some of them to the bank that doesn't have enough. This lending of central bank reserves between commercial banks is called the interbank lending market. And as long as the banks that end up with more reserves than they need are happy to lend it to the banks that have less reserves than they need, then all banks will be able to make their payments and there's nothing to worry about.
To clarify further, central bank money is essentially monetized credit between banks and partly the government. Monetized, meaning that holding it is risk neutral to banks as this risk is carried by the central bank.
So a bank can actually make a loan, creating new money in the hands of the public, even if it doesn't have the reserves, because it knows that at the end of the day, when all payments are netted out against each other, another bank will be there willing to lend it some reserves to settle its own payments. So as long as all banks are increasing their lending at roughly the same rate, the money supply can keep increasing without the need for additional reserves. So banks don't really depend on having reserves before they can create money. They can make the loan first and find the reserves to settle the payment by borrowing them from another bank. And collectively, banks can increase the money supply almost indefinitely without being restrained by the amount of central bank reserves. In fact, before the financial crisis, the ratio between the bank-created money in the hands of the public and the central bank reserves was 80-1. Of course, this only works if the banks are willing to lend to each other. If they think that the other banks might not repay them, then they'll refuse to lend. If some of the banks decide to sit on their reserves and to refuse to engage in the interbank lending market, it becomes a mathematical certainty that one of the other banks will struggle to make its payments. If this happens, then the entire payment system could very quickly fall apart. This is what happened during the financial crisis. The only way to avoid this is for the central bank to pump in such a huge quantity of reserves that every single bank has more reserves than they need. This would mean that they no longer need to lend to each other. This is effectively what the quantitative easing scheme did, by pumping reserves into the banks and making it unnecessary for them to lend to each other.
What this pumping means is the central bank started granting loans of new central bank money to retail banks without limitation, and also started paying interest on the central bank accounts, making it less costly for the retail banks to hold bigger reserves. This allowed them to continue clearing payments with each other without having to carry each other's bankruptcy risks. Their liabilities to each other were now monetized through the central bank, as explained. The other kind of quantitative easing programs that are intended to stimulate the economy, also known as QEs, are more often about buying up government bonds instead of the bank's own corporate bonds like in the previous case. Both kinds mainly increase interbank liquidity and not the actual money supply for individuals and companies. The popular expression of printing money is very misleading. When the government bonds are bought from non-bank investors, they can increase liquidity in the actual market as well, but even then such stimulative attempts are doomed to fail. The whole assumption of the quantity theory that increased liquidity would increase consumption or real investments makes little sense. Reflect for a moment. How much does having a bigger proportion of your savings in liquid deposits or cash instead of in, for example, bonds or shares affect your spending behavior? And now, consider the same for a richer investor not living hand to mouth, or an institutional investor like a pension fund or a foundation. Increased liquidity alone is not going to make any of them spend any more or work any less, and hence has hardly any effect on the aggregate supply and demand for labor.
During the second round of quantitative easing, global food prices went up 60%. So quantitative easing was the spark that ignited the Arab Spring.
But we're sidetracking a little bit here. Back to the limitations imposed on banks.
So far, we've seen that there is no liquidity reserve ratio, and that banks don't really need to have central bank reserves in order to lend. What about the capital adequacy ratios, or Basel Accords, that everyone's talking about? Well, the capital adequacy ratios relate to something quite different. But to understand why, we need to look at the balance sheets again.
Listen closely here. It is a common mistake to confuse capital requirements with reserve requirements.
Remember that the asset side of the balance sheet shows everything that the bank owns, including all its loans and mortgages, and the liabilities side shows everything that the bank owes to other people or companies. There's a third part of the balance sheet, which is something called shareholder equity. Shareholder equity is very simply what's left for the owners of the company when all the assets are sold and all the liabilities are paid off. To avoid going bankrupt, a bank needs to make sure that its assets are greater than its liabilities. When somebody defaults on a loan and stops making repayments, then the bank has to repossess the house and sell it off, usually at an auction. The bank will usually get less at the auction than the original value of the loan. That means that it loses money by repossessing the house. The mortgages on the balance sheet that was originally $250,000 has turned into a house that will be sold for less than $250,000. So when loans and mortgages go bad, it reduces the assets of the bank. Now, if only a small percentage of the loans go bad, there's no problem. The bank already expects at least 1 or 2 out of every 100 mortgages to go bad. That's just part of the risk. And besides, the interest payments from the loans that don't go bad should cover these losses. But if everyone starts defaulting at the same time, then the bank's assets can start shrinking rapidly. If the assets shrink so much that the bank's assets are less than their liabilities, then the bank is insolvent and should be liquidated and shut down. The problem is that while the bank is being liquidated, most customers will be unable to access their money. This can cause big problems in the economy and could even trigger a panic that leads to people trying to get money out of their other accounts and causing those banks to have difficulties too.
This isn't necessary. A bank going bankrupt does not necessarily have to mean immediate liquidation of all of the bank's assets. Both credits and remaining assets can simply be nationalized first and liquidated gradually. And even then, liquidation does not necessarily mean requiring immediate repayment of mortgages and fire sales of houses. The mortgage contracts can be sold to other banks as they are. As explained, outstanding loans are assets to banks, and their repayments can continue as before. These kinds of procedures can be developed, as Jamie Dimon explains.
Number two is we have to get rid of too big to fail. So if I was sitting in any other seat other than my own, I'd say, you know what? You should never pay if JP Morgan fails. You need a way to bankrupt, and I prefer bankruptcy. It should be called minimally damaging bankruptcy for big dumb banks, as opposed to this vague concept of orderly liquidation or resolution. Kind of sounds like you're resolving us, but we may still be around. I think it should be called bankruptcy. Matter of fact, I think Kevin Warsh recommended Chapter 14. It needs specialized stuff, because just like in a hospital, when it goes bankrupt, you can't turn the lights off because it may be operating. In a financial company, all you need is the money keeps them running through the system. It doesn't get locked up. It could be done. In fact, it was done quite successfully by the FDIC for a long period of time.
The trouble is that even in such controlled bankruptcies, the government takes hits through its deposit guarantee and central bank holdings of the retail bank's bonds, unless there are big enough buffers of non-guaranteed credit protecting the deposits and bonds bought by the central bank. This allows banks to pass on their bankruptcy risks on the government by over-leveraging themselves. This is why we need to put a proper fee on the deposit guarantee and require that risk premiums of corporate bonds don't rise higher than this guarantee fee. The deposit guarantee is explained in Part 5.
So to try and prevent this from happening, there is something called the Basel Accords, or capital adequacy ratios. Capital adequacy ratios basically require the banks to keep a buffer that's big enough to absorb losses by the banks. The bigger the buffer, the more of a bank's loans can go bad before it becomes insolvent.
As said, when the government guarantees deposits for free, and especially when there are bailout expectations due to banks being perceived as too big to fail, the bank's credit costs don't rise with additional leverage, which encourages excessive leverage. The Basel Accords have been created to treat this symptom. But the twisted thing about the Basel Accord system and such bank solvency regulation in general is that it should be the banks and their investors' business to assess and manage risks as fairly and efficiently as possible. Now, the Basel system comes in and does this for them, determining required capital ratios for different asset classes. And practically the best way remaining to achieve a competitive advantage over other banks is to be better at circumventing and cheating the regulations by, for example, repackaging their assets through complex networks of funds and subsidiaries. It hence discourages transparency and results in a regulatory arms race between banks and their regulatory institutions, constantly reducing transparency, increasing systemic risks, and the complexity of regulations. The regulatory institutions themselves, of course, don't mind, as this gives them more and more funding and justification for their existence. But simultaneously, this setting removes the raison d'être of the whole private banking sector.
We won't go into too much detail on how this scheme works here, but the key thing you need to know is this. When the bank makes a profit on its loans, then this profit increases the size of the capital buffer. If its capital buffer is bigger, then it can afford to make more loans. So when the economy is improving, the ability of banks to lend will also increase. This leads to them lending more, making more profits, and further increasing their ability to lend. In other words, capital adequacy requirements don't limit the ability of banks to create money when the economy is doing well. However, they do limit the ability of banks to create money when the economy is doing badly. And as we've seen, the money supply of the nation is dependent on the lending of banks, which means that the capital buffers make the instability in the money supply even worse.
This is a bit of a rash conclusion. Yes, profits increase shareholder equity and losses reduce it. But we should note that paying dividends to shareholders also reduces the company's shareholder equity, and new equity can be raised by issuing new shares. If a bank issues new shares and the buyers are banking with the same bank, what essentially happens is that the bank replaces their deposits with shares, turns its debt liability to them into an equity liability. Therefore, the profits banks make don't limit their ability to make new loans either, as long as they are able to gather more equity investments from the market. Also, when competition between banks is fair, it isn't necessarily so that bank profits rise when the economy is doing well and vice versa, although there is surely a correlation, as depressions tend to increase credit defaults unexpectedly.
But the important thing is that the capital adequacy reserves are not, and never have been, intended to limit how much money the banks can create or how much reckless lending they can do. It's simply about trying to ensure that when things do go wrong and loans start going bad, the banks have enough of a buffer to avoid going bankrupt. So to sum up, what does actually limit the ability of banks to increase the money supply? We've seen that the type of reserve ratio that's discussed in the textbooks has never even existed in the UK. We've seen that the liquidity ratios that did exist have been reduced and eventually abolished, and that even when they did exist, they only limited the speed that the money supply could increase, but put no limit on the total size that it could grow to. We've also seen that the capital adequacy ratios and Basel Accords are about preventing banks from going bust when loans go bad, rather than limiting their dangerous lending or limiting how much money they create through lending. And although the capital adequacy requirements can restrain lending after a banking crisis, it doesn't do anything to restrain lending in a boom. We've also seen that there is no natural limit on how quickly the banks can create money. They know that even if they don't have the actual central bank reserves to make payments, they'll be able to borrow those reserves from other banks, or even the central bank. All this comes together to imply that the only thing that truly limits the creation of money is the willingness of banks to lend, and their willingness to lend depends on their confidence. In other words, the money supply of the nation depends on the mood swings of banks and the senior bankers that run them. This is surely an insane way to run an economy.
It is quite sensible to require that all credit granted has someone who is prepared to carry its credit risks. The only thing preventing that from happening currently are the free deposit guarantee and the bailout expectations. And it is also very sensible not to try limiting how much people can owe each other to a specific amount, but simply to keep the demand for holding credit and for being in debt in balance by establishing a working market interest rate mechanism, which is what conventional central bank monetary policy in effect does. but of course this fails when interest rates have a zero lower bound. Of course, this is not how the monetarist theories that are behind the system describe it. Ironically, they have come to the right policy conclusion, controlling inflation with interest rates, based on a completely mistaken causal theory. It happens. What is insane is to assume that one could run an economy, in other words, keep the aggregate supply and demand for labor in balance by externally limiting the amount of liquidity there can be. It is positively surprising how well the positive money team points out that the distinguishing feature of money from other credits is its risk-free nature. But what they have not quite grasped is that money, including cash and central bank reserves, is also credit.
Well, money is just a special form of IOU.
It is a risk-free subset of credit. Separating it into a completely different category and assuming its quantity would have some magical effects on the economy is misleading. Moneyness is not a discrete 1 to 0 thing, but other forms of credit also have their degree of moneyness and can increase liquidity in the economy. Examples of privately issued, partly liquid credit include vouchers and their own virtual currencies that some large internet service companies release. In our current system, there is not just one distinct quantity of money, but statisticians measure different monetary aggregates. M1 is usually the most liquid aggregate, including liquid deposits and cash, except for the cash held as bank reserves. In some countries, M4 is used to refer to all credits in the economy. These are pretty well explained in, for example, Wikipedia. For the positive money team, revisiting Alfred Mitchell Inn's credit theory of money from 100 years ago might open up some new perspectives and mental images. But disregarding this definitional dispute, Part 5 is a very good explanation of the deposit guarantee system and its implications.
You might hear some people say that banks don't create money, they just create credit. This response often comes from civil servants and people trying to deny that banks now create the nation's entire money supply. So let me show you why the numbers that banks create are money and not just credit. The key thing about credit is that it has something called credit risk. Credit risk is the risk that a person or company that owes you money won't pay you back. If you lend £50 to an unreliable friend who still owes you money from the last time you lent to him, then there's a lot of credit risk attached to that loan, because it's fairly likely that he won't repay you on time. So, if the numbers that banks add to your bank account are not money, but just credit, then there must be some credit risk attached to that money. In other words, there must be a risk that the bank won't be able to repay you. And of course, as we saw with Northern Rock, Wachovia and the Icelandic banks, there is a pretty good chance that your bank won't be able to repay you. In fact, in a legal sense, the numbers in your bank account aren't money. They're just a promise to pay from the bank. The promise is that the bank will either give you cash when you ask for it, or will electronically make payments to other banks when you ask them to. So that would suggest that there is credit risk attached to the numbers in your bank account, because the bank may not be able to repay you. And that would suggest that the numbers banks create are not money, but just credit. In fact, the Bank of England actually follows this argument and points out a distinction between cash and bank-created money. In their 2010 Q3 quarterly bulletin, they say that
Bank of England notes, i.e. the cash in your pocket, are a form of central bank money, which the public holds without incurring credit risk. This is because the central bank is backed by the government.
Interesting. So, cash has no credit risk because it is backed by the central bank, which is backed by the government. But the commercial banks aren't backed by the government. So that implies that the numbers they type into people's accounts must be credit and not money. But hang on a minute. The government has a scheme called the Financial Services Compensation Scheme, or FSCS. This scheme promises to repay you up to £85,000 if your bank goes bust and loses all your money. In fact, you might have seen them advertising this scheme on the tube or buses. This guarantee is supposed to be funded by contributions pooled across the banks. But if the contributions from the banks aren't enough, as happened during the financial crisis, then taxpayers have to make up the rest of the money. Just think about what this means for a second. This guarantee scheme amounts to the government saying, you give your money to a bank, let them do whatever they like with it, and if they lose it all, we'll just use other people's money to reimburse you and make sure you don't lose a penny. In what way does this not count as the banks being backed by the government? Here's the bottom line. The numbers that banks type into customers' accounts would be credit and not money if, and only if, there was a credible risk that you might not get all that money back. If that was the case, then bank deposits, the numbers in your account, would actually be a risky investment, and anyone putting their money into the bank would have to accept that they might lose something or all of their money. If this was the case, then banks would just be extending credit, even though their payment systems would allow you to use that credit to make payments. But because the government steps in and guarantees all this bank credit, it completely removes all the risk. In effect, the numbers that the banks create are fully backed by the government guarantee, and therefore they don't have any credit risk. There is absolutely no difference in the riskiness of a banknote created by the Bank of England and a number typed into a bank account by one of the high street banks.
A most important implication of this is that as a depositor, you are not financing your bank. And this is not because you didn't actually give them money, but because you are not carrying the bank's business risks. The deposits are a form of finance for the bank, yes, and a significant one as they form a major part of the bank's liabilities. But because the government guarantees them, the government is effectively financing all retail banks, and doing it for free. Financing is not about giving money, but about carrying risks. In finance, what matters is exposure to risk. As an example of financing without giving money, I can finance a startup company I own with sweat equity, in other words, working for it without paying myself a salary. This is why many activist groups, including the Positive Money team at least formerly, are raging in vain when they consider it a problem that depositors don't know what their money is being invested in or whom it is lent to.
Flaw number 2, banks can invest your money however they like. Your life savings could be helping to fund British Aerospace's latest weapon of mass destruction.
Their deposits are not being lent to anyone or invested in anything.
Banks do not lend money.
Even if, hypothetically, say, Barclays financed arms manufacturers by proprietary trading their shares and granted credit to oil companies clearing rainforests, as a depositor at Barclays, you are not supporting or facilitating these activities in any way, as you are not exposed to their business risks. Of course, lots of people pulling out their money from Barclays would require Barclays to borrow lots of central bank money from other banks or the central bank, and in the current situation, this would raise Barclays' credit costs somewhat. In this sense, depositors do have the power to decide to which banks they want to distribute their share of the government subsidy that the deposit guarantee is.
So to sum up, the numbers in your account are just as good and just as safe as the cash created by the Bank of England, because the numbers in your bank account are guaranteed by the government. In other words, what banks create when they type numbers into bank accounts is money, not credit. When the government steps in to guarantee that you won't lose a penny even if your bank does something stupid and is unable to repay you, then it effectively converts the risky credit of the bank into a risk-free form of money, backed up with taxpayers' funds, but which the government permits private companies to create out of nothing. By the way, probably the main reason why civil servants in the Treasury and the Banking Commission try to argue that banks can't create money is that if they acknowledge that banks had acquired the power to create money, then they'd have to deal with the serious implications of giving one of the greatest powers that government has to a private, short-term profit-seeking collection of corporations.
Or they'd have to consider the possibility that the money supply is endogenous, that it has little direct causal effect on aggregate demand, and that the money multiplier models and monetarist theories which officially govern our economic policies are outdated bullshit with little correspondence to reality.
Remember how new money is created when a bank makes a loan? Well, when someone repays the loan, the opposite process happens and money is actually destroyed. It effectively disappears from the economy entirely. This is vitally important because it means that if we, the public, start reducing our debts by collectively borrowing less and repaying more, then the amount of money in the economy will actually start to shrink. If we all collectively reduced our debts by 1 billion, then the money supply of the economy would actually fall by 1 billion. There will be £1 billion less money changing hands in the economy.
Approximately so, yes, but it can also mean a reduction in non-liquid credit. It is possible to increase liquidity by selling non-liquid bonds, government or corporate, to banks, which can buy these with new liquid credit without an increase in total debt. Or governments and corporations can pay off such debt not held by banks.
If we significantly reduce the debt, then the shrinkage in the money supply could actually cause the economy to slow down or grind to a halt. Just think of the problems caused when banks refused to lend during the credit crunch.
If you assume, along the quantity theory, a direct relationship between the quantity of money and the amount of trade occurring, in addition to banks refusing to lend, the collapse of the real economy in the credit crunch was caused by savers spending less and companies halting their real investments. If we can make holding on to deposits and cash less lucrative, we can run an equally active economy with a much smaller amount of liquid monetary buffers as well. The last 2 decades in Japan are a good empirical case example of how there really is no even remotely linear causality from the quantity of money or debt to inflationary pressures or economic growth.
So, although we all think it's a good idea to get out of debt, and most of us are trying to get out of debt, as long as we keep the current system, it will be impossible to reduce our collective debt without slowing down and potentially destroying the economy.
Correction. Without reducing the amount of monetary savings in the economy.
So let's see exactly how money is destroyed when a loan is repaid. Let's start with Robert, who still owes £10,000 to Barclays, but has spent the money, leaving his bank balance at zero. After a few months, Robert decides to pay down £1,000 of the loan. He transfers the money from a bank account with another bank to his bank account at Barclays. We won't show the central bank reserves on this process because, as we saw with the clearing process, any change in the reserves would probably be cancelled out by payments going in the opposite direction. I won't change things in any significant way. Now, Robert still owes £10,000 to Barclays, but also has an account with Barclays that now has a balance of £1,000. As a result, Barclays has a liability to Robert of £1,000. That's the numbers in Robert's bank balance. And Robert has a liability to Barclays of £10,000. When Robert called Barclays and says that he wants to pay off £1,000 of the loan, all Barclays does is reduce Robert's bank balance to zero and reduce the outstanding loan by £1,000. In effect, both the asset and the liability are cancelled out against each other. Because the money supply in the hands of the public is made up of bank-created numbers in people's bank accounts, repaying loans in this way actually reduces the amount of money in the economy.
To generalize a bit further, as money essentially is banks' debt to others, money is created whenever a bank makes any payment to any non-bank entity. This does not only include granting loans, but also paying salaries, interest, and shareholder dividends. A bank paying simply means that it falls further into debt to the recipient by increasing the balance on that person's account. Whenever banks receive payments from non-banks, they destroy money, simply reduce the number on their accounts.
Money, the type of money that the public use, has been destroyed in the act of repaying the loan.
But the words destroy and create are a bit misleading, as they make money sound like a thing when it is a relation. And most people wouldn't talk about creating a distance or creating a friendship. Or at least wouldn't abhor someone creating them out of nothing. The insight that banks create money in all their payments also solves the perpetual debt hoax that so many activist groups insist on using to demonize our monetary system. The claim that charging interest would result in perpetual debt that it is mathematically impossible to pay back.
And that's not all. Banks create only the amount of the principal. They don't create the money to pay the interest.
In other words, almost every single dollar that exists
must be eventually returned to a bank with interest paid as well. But if all money is borrowed from the central bank and is expanded by commercial banks through loans, only what would be referred to as the principal is being created in the money supply. So then, where is the money to cover all of the interest that is charged? Nowhere. It doesn't exist. The ramifications of this are staggering, for the amount of money owed back to the banks will always exceed the amount of money that is available in circulation.
More and more new debt money has to be created to satisfy today's demands for money to service the previous debt.
Yeah, scarcity is built into the money system. On a most obvious level, it's because of the way money is created as interest-bearing debt. So anytime a bank lends money into existence or the Federal Reserve creates money, the money comes along with a corresponding amount of debt. And the debt, because there's interest on it, is always greater than the amount of money. So it essentially throws people into competition with each other for never enough money. Growth is another thing that's built into our money system.
This system requires that we go deeper into debt every month than we were the previous month. We have to always borrow more currency into existence than we are extinguishing every single month, or the whole thing starts to collapse.
All credit relations are two-sided. In other words, all debt is to someone else, and therefore, if you really did your math, you could conclude that all debts can be paid back as long as the creditor buys more from the debtors than he charges interest.
Of course, now that Robert's loan has been partly repaid, Barclays might go hunting for another lending opportunity and make a new loan to replace this, in which case new money will be created and the money supply will grow again. But if banks are scared to lend, for example, following a major financial crisis, and the public are trying to reduce their debts, then the money supply of the economy will shrink. Here it is in the simplest form. If we want more money in the economy, we need to go into more debt. And if we want less debt in the economy, we have to have less money.
Exactly. And that is why we can only deleverage our economy by making savers, the net creditors in the economy, spend off their savings so that they can be earned by the indebted to pay their debts back. Saving money excessively is indebting others. And this is the mathematical balance sheet fact that our sticky, hundreds of years old Protestant work ethics don't allow us, including politicians and economists, to say out loud, and which makes the positive money team consider our current system perverted, and with their faith in the quantity theory, suggest a move into a system of inelastic liquidity, encouraging yet more hoarding and speculation in uncertain times. When we discard our emotional associations with debt and money, and the inherent virtue we still attribute to saving and frugality, we see that a monetary system definitely needs the possibility of negative interest rates. Also, what people don't seem to know is that the return on deposits, cash and bonds, risk-free assets, is what determines the profit requirements of all other investments made in the economy. If interest rates could turn negative and land value taxation was implemented to remove the profitability of hoarding real estate, we'd have effectively removed the minimum wage of capital. If we additionally imposed a proper fee on the deposit guarantee, this would lower interest rates further, making government debt at times a source of revenue instead of a cost. We could even end up in a situation where companies are profitable without making a profit. This sounds like a conflict of definition, but it's pretty clear when you understand a bit of discounting and corporate finance, as well as economic theories of interest and capital. Of course, whether negative rates persist or not then depends on the actual supply and demand of capital, in other words, people's desire to save, and the need for investments in real productive assets. Going back to money, held money of any kind essentially represents claims on future goods and services produced by others. In other words, it is power over other people. Dreaming of debt-free money is wanting people to have power over others, but no one to have power over them. that they wouldn't have any liabilities to others themselves, but would still be able to expect things from others on demand. It is easy to see how such a currency is inherently speculative. Instead, a credit money system where money is backed by explicit liabilities and that involves a working interest rate mechanism is on a much more reliable basis. So, what about gold or silver?
The reason that gold and silver are the optimum form of money is because of their properties.
And the gold coin is clearly something different.
Because gold and silver store a large amount of value in a very small area.
I'm talking about value, intrinsic value of the metal itself. People want gold for itself. First, it was valued as a commodity. It was a luxury good known throughout the world.
Yes, gold has some intrinsic use value in, for example, electronics, and symbolic and aesthetic value in jewelry. But when gold is used as money, most of its market value is not this intrinsic use value, but based on the expectation that someone else will be ready to give something in exchange for it.
Your true wealth is your time and freedom. Money is just a tool for trading your time. It's a container to store your economic energy until you're ready to deploy it.
But in net, mankind as a whole cannot increasingly store more and more value by saving up more and more and more gold, as its quantity is limited.
It's limited in quantity. That's the reason that it maintains its purchasing power.
And even if some more gold can be produced through mining and refining, we don't eat gold or live in it. It only stores value for an individual as its exchange value for other things. Even if the value of gold rises, it is not an increase in real wealth, as in productive assets or consumable goods.
Creating money doesn't create any new resources. It doesn't bring any more oil out of the ground than is already there.
When some party has promised to accept gold as payment for its services or is legally required to do so, gold is de facto credit on that party. The government accepting a kind of money as settlement for tax obligations is just one example of such a situation. On the other hand, when gold money is no one's explicit liability, it is practically a constant speculative bubble. Or what else would you call a commodity, the market value of which is based on people expecting others to pay for it in the future, because they expect others to pay for it in the future, because they expect, and so on, with considerations completely divorced from actual production costs or demand for consumption. A constant speculative bubble. And you expect that to keep the aggregate supply and demand for everything else in balance? Just before the crash leading to the Great Depression of the 30s, Irving Fisher formalized one theory of how such a medium of exchange of limited supply could do that, and it clearly demonstrates the completely unrealistic assumptions that would be required to hold. And these assumptions also implicitly include the idea that all transactions would be conducted in cash, and the quantity theory that all of that physical cash would have a constant circulation velocity. Fisher himself later admitted that the assumptions of markets clearing and that all debts are repaid cannot be expected to hold, and as explained before, his view of banks lending on other people's money has become even less applicable with today's electronic payment technologies. Of course, you can try to make your own theory with better assumptions.
Yes, it is the ultimate money because there is nothing else even in the same league. It's divisible, it's permanent, it's a store of value, it's a unit of account. It's got everything you want out of money, but it doesn't go away and it can't be increased.
And these properties are what make gold money, when forced upon people, for example by landowners requiring rent to be paid in it, the ultimate tool for usury, debt enslavement and extortionary capitalism. Ownership of limited vital resources like land or fresh water are the types of monopolies that allow extortion in a market economy. Tying debts and savings to a commodity of limited supply and then turning that commodity into a necessity for participating in the economy makes money another limited vital resource and hence makes it extremely profitable to hoard that commodity as much as possible, especially in economically uncertain times. This is sure to turn any economic shock or recession into an economic collapse. Falling prices and wages turns debtors in this currency into debt slaves of the incumbent holders of that money and credit denominated in it. Reflect for a moment. Would you dare take a mortgage or credit finance for your company tied to something as volatile as gold or Bitcoin? If you think that would be a good idea, you are completely free to do so. Even in the current system, you can construct your own gold standard mortgage with the help of gold ETFs or other derivatives. As these gold standard propagandists emphasize, a shift to gold money would be a massive transfer of wealth to incumbent gold owners.
The wealth transfer that will take place during this decade is the greatest wealth transfer in history.
No wonder gold investors like Mike Maloney spent so much time trying to convince people that the future will be that dystopia.
And so I sort of made it my mission to try and wake up the middle class, to let them know how the monetary system works.
And the fluctuations in the purchasing power of gold under a gold standard monetary system would be constantly recurring wealth transfers between debtors and creditors. We don't need money to be a store of value in the sense of being a profitable long-run investment. The existence of such an investment alternative only reduces actually productive real investments and raises their profit requirements. What a working economy needs is a unit to which we can tie our savings and our debts, and the purchasing power of which is predictable. In other words, that it is risk-free in terms of average future consumption expenses, and the return on which, the interest rate, can keep current aggregate supply and demand in balance regardless of how high that aggregate demand is, hence forcing no growth dependence, but facilitating any actually desired growth. And that is what the dollar and the euro and our other accounting units could be without the zero lower bound and with the proper price on the deposit guarantee. But understandably, it's not easy to see past this self-contradictory perception of money as a medium of exchange, guiding both gold and positive money advocates, as it is strongly supported by the misleading conceptual metaphor of money we use in our language, and our outdated Protestant work ethics, which desperately want to see intrinsic value in money and inherent virtue in saving and frugality. Currently, this commodity moneyism is gaining almost religious proportions, as can be seen, for example, in the hype around Bitcoin.
And for the true believers, it is the future,
which is one of the most ingenious crossbreeds of a pyramid and Ponzi scheme in our economic history.
It's like a highly speculative asset. Bitcoins are 800 today. I mean, how do we know a year from now they could be 5,000? They could be 50. Because you can't just hedge your Bitcoin exposure. So
what prevents somebody else from coming up and saying my algorithm is even better than the Bitcoin algorithm? There goes the value of Bitcoin.
Leveraging both the trendy hatred towards banks,
bye-bye buffoons and banksters,
and the temptation of unearned gains by current holders.
It's making some people really rich.
Billionaires to be made.
Unlearning and questioning is much harder than learning incremental things on previous assumptions. If you have the patience to look past your emotional attachments and ideological convictions, and believe you have the ability to entertain ideas without accepting them, all of this is explained in more detail, and many other illogical and unnecessarily limiting assumptions are questioned in the book Fixing the Root Bug, soon available digitally and in print at rootbug.org.